An initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. An IPO allows a company to raise capital from public investors. The transition from a public to a public the transition from a private to a public company can be important time for the private investors to fully realize gains from their investment, as it is typically includes a share premium for current private investors. Meanwhile, it also allows public investors to participate in the offering. An initial public offering refers to the process of sharing a private corporation to the public in a new stock issuance. Companies must meet requirements by exchanges and securities. IPOs provides companies with an opportunity to obtain capital by offering shares through primary market. Companies hire investment banks to market, gauge demand, set the IPO price and date, and more. An IPO can be seen as an exit strategy for companies' founders and early investors realizing the full profit from their private investment. How does an IPO works? Before an IPO, a company is considered private as a pre-IPO private company. The business have growth with relatively small number of shareholders, including early investors like founders, family and friends, along with professional investors such as venture capitalists or angel investors. An IPO is a big step for a company as it provides the company with access to raising a lot of money. This gives the company a greater ability to grow and expand. The increased transparency and share listing capability can also be a factor in helping it obtain better terms when seeking borrowed funds as well. When a company reaches a stage in its growth process where it believes it is mature enough for regulations along with benefits and responsibilities to public shareholders, it will begin to advertise its interest in going in public. Typically, this stage of growth will occur when a company has reached a private value of approximate 1 billion. However, private companies at various valuation with strong fundamental and proven profitability potential can also qualify for an IPO depending on the market competition and their ability to meet listing requirements. When a company goes public, the previously owned private shares converts to public ownership and existing private shareholders become the public trading price. Meanwhile, the public market opens up a huge opportunity for millions of investors to buy shares in the companies and contribute to the company's shareholders' equity. The public consists of individual or institutional investor who is interested in investing in the company and raising its profit. Overall, the number of shares the company sells and the price for which the shares sell are the generating factors for the company's new shareholders' equity value. Shareholders' equity still represents shares owned by investors when it is both private and public. But with an IPO, the shareholders' equity increases significantly with cash from the primary issuance. Thus, companies can raise equity capital with the help of an IPO by issuing new shares to the public, or the existing shareholders can sell their shares to the public without raising any fresh capital. IPO is used by small and medium enterprises, startups, and other new companies to expand, improve their existing businesses. An IPO is a way for companies to acquire fresh capital, which in turn can be used to finance research, fund capital expenditure, reduce debt, and explore other opportunities. An IPO will also bring in transparency into the affairs of the company, since it will be required to inform financial numbers and other market related developments on time to time stock exchange. An unlisted company, a company which is not listed on the stock exchange, announces initial public offering when it decides to raise funds through sale of securities or shares for the first time to public. In other words, IPO is the selling of securities to the public in primary market. A primary market deals with new securities being issued for the first time. After listing on the stock exchange, the company becomes a publicly traded company, and the shares of the firms can be traded freely in the open market, hence increasing the capital.